So if you want to
Joe.
introduce Scott, no, there are. I never have an issue. So I close non-QM deals with them in 10 days. That just doesn't happen. So literally. So I appreciate, thank you for coming out for us, dude, taking the time.
Thank you.
Just introduce Scott.
Nice to meet everybody. Pleasure to meet everybody. So are you guys familiar with non-QM loans? And has anybody here closed any of those before? Yeah, couple? Okay, good. I really like talking about these loans with the realtor community because it all starts with you guys, right? So you guys are the ones talking to buyers right up front and, you know, sharing information. So you guys have the knowledge of understanding a little bit about how these programs work really goes a long way. I mean, you don't have to be an expert, obviously. That's why you have Joey here. But just having an idea that it's available is going to help you put more buyers into more homes throughout the course of the year. And so to kind of just give you a little background, Joey went over our background. Great. 2014, we started in the non-QM space. We were one of the first lenders to bring it back. That's all we do, by the way, is strictly non-QM. We don't do conventional loans. We don't do FHA. We are 100% experts and specialists in non-QM. And that's how we want to keep it. We want to be able to offer you expertise in that segment of the market. So to give you a little bit of background on non-QM, because I've learned from presenting to realtors that there can be some confusion sometimes. So I like to clarify it. A non-QM loan is no different than a conventional loan. It functions, it operates, and it goes according to the same regulations as a conventional loan. The only difference is a conventional loan is being sold to the government, Fannie Mae, Freddie Mac, FHA. A non-QM loan is being sold to secondary markets, Wall Street, insurance companies, hedge fund managers, asset managers. That is literally the only difference. Obviously, guidelines are different, right? Programs are different, but I'm talking in terms of the overall loan process. It's exactly the same. So I know that there's sometimes been a fear in the realtor community, like, oh, non-QM, what does that mean? Where's my DU, right? It's no different. You guys can feel comfortable knowing these loans function. We're regulated. We have TRID, we have CD rescission. We have all of the same exact thing you experience on the conventional side. And over the course of the time that non-QM kind of came back into the marketplace, we've really done a good job of trying to bring it as close to what you're seeing in the conventional space, just using our products and programs. So today we're going to talk about some of the details of the programs and how they can help you guys as agents put more buyers into more homes.
So I just want to say one thing, because top of what he said is there are non-QM lenders out there. They're the biggest. If you ever get a non-QM offer, you're hearing that, you want to ask who they're using. Yeah. If they're not asking, there's really 2 or 3 big players that get it done. There's a lot of baby players out there. So if you get one that you don't understand or you don't ever heard of, like I just had one that we rescued a loan. They went to a company, Logan Financial, never even heard of them. Right? These one-offs that are coming out, they're trying to get things done that can't get done. Investors aren't buying and deals are falling apart last minute. Yeah. So you want to make sure, like his non-QM files, they come with a pre-qual. So whenever you get if they say, oh, I'm using Angel, great, can I see your pre-qual? Yep. Right? You want to say, they don't have a DU, but you can get a pre-qual. So you want to know these things. And obviously talking to us, we can help you walk you through it. But it's one of those things like work with one of the big players because the little players are not, it's a 50-50 coin toss. With them, it's 100%.
Yeah, Joey brings up a good point, and that's important for you guys as agents to know and to understand because, you know, as we all know in this business, real estate mortgage, it's about relationships, right? And it's about who you work with. You guys, I'm sure, are all familiar with UWM. You're all familiar with the bigger name conventional lenders out there, right? So, you know, we tend to think we are the UWM of the non-QM space. But because non-QM has blown up, has exploded, and it's growing so rapidly, especially right now as we speak, there's such a huge opportunity in this space. There are a lot of new lenders coming into the space looking to capitalize on that. And, you know, it's not to say they won't be successful, but they're just, you know, 8, 9, 10 years behind us in terms of the progression, right? So it's important to keep that in mind. So we're going to talk about who these types of buyers are and how you can help them and where this is going to come into play for you guys to take advantage of these products and programs. So probably the biggest segment that non-QM was invented for was for the self-employed borrower, okay? We all know self-employed borrowers, business owners, 1099s like you guys, right? Schedule C, people that file and don't have an entity or don't get paid 1099. For a very long time, they've had a hard time purchasing a home because historically speaking, if they went conventional, you would have to go off of whatever the income is that's on their tax returns, right? But we all know that business owners, 1099 individuals are doing what they should be doing. And they're taking advantage of the beautiful tax laws we have in this country to write off as much of their expenses as they can. So the net income is not truly indicative of what the true income is, the true cash flow is, I should say, for that particular borrower. That's where these self-employed programs came into play. And the first one, the most popular one still today, is the bank statement program, which many of you have probably heard of. So where we're qualifying a self-employed individual, whether they're a business owner, a 1099, or a Schedule C, by taking all of the deposits that come into their bank statements and using that revenue to qualify them for the income that's being used to qualify the loan. Follow me? So we're totaling up the deposits. We're doing a calculation on our side using the bank statements. We're not even looking at the tax returns. There is no 4506. There is no transcripts. It is strictly based on the cash flow of the bank statements. Okay. And there's a lot of nuances within that Joey could always help educate you guys on as you're going on a case-by-case scenario, because you might have, two borrowers, a couple where one of them owns a business and the other one's a W-2. Well, guess what? We can combine both incomes, right? You might have two borrowers that are both 1099, right? You might have one that owns a business, one that's kind of, doing some house cleaning or something on the side. We can combine those incomes. There's a lot of flexibility within these programs.
And one thing that, go ahead.
Quick question. There's a back
It does, yes. In all cases. So the accountant letter, and it's a CPA, accountant, or tax preparer. And what that letter does is, because we're not asking for tax returns, because there's no 4506, that CPA letter is confirming to us on a business owner what percentage of the business that borrower owns. And if it's a 1099, it just says, I can confirm this individual has been filing 1099 for the last 2 years. Okay. Case by case. So in some cases, if we're using what we call, not to get too detailed, less than a 50% expense ratio, right? So we're taking less than 50% of the deposits in the bank account, then we do need the accountant letter just to confirm that that business operates at an expense ratio of 20%, 10%, 15%, whatever the case might be. And we see that a lot because a lot of businesses today are people that maybe are doing something online or basically don't have a brick and mortar physical location. They're operating from home or from a small office suite. So the expenses are minimal. So we do see that a lot, but that's a good question. All right.
I just want to say one thing about the bank. So you guys know that we thoroughly go through the process with all our buyers, right? That's what makes these things close quickly, close easily. So same thing goes with this. When I get a file in, first thing Scott tells me is I need the loan app. And this is before we're under contract. Loan application, I want to see the 12 months bank statements and I want to see, narrative on the loan. He comes back to me and says, okay, here's what you look like. So it's our basically like done before we even get going. So when your buyer goes out there with a pre-approval letter from us, it's like solidified. The only thing that could go wrong at that point would be if the property has an issue with appraisal or like a bad inspection.
Great point.
Yeah, our non-QM stuff is really tightened down. So I'm very confident to close them quick.
Great point. So to Joey's point, what the way our process works is when he has a buyer, he'll send over to me their bank statements. If he has the credit in the application, he'll send that as well. And we run through an AI software, what we call an official bank statement income calculation. So that spits out a detailed worksheet of the income. That worksheet is what the underwriter is using when the loan gets to underwriting. But we're doing that up front. This is at the pre-approval stage. So on a bank statement loan, I've historically said, I think it's more solid than a DU because we're actually looking at the income docs. On a DU, an underwriter has not yet seen those income docs, right? Yeah. On a bank statement loan, especially for self-employed borrowers, it's important for you guys to know when you see that, that's a solid income and you could take your buyer shopping. The other part to that, Joey, is how many times have we seen, and we talked about it before, the tax returns show, 80 grand a year in income reported. And then we run the bank statements and we're talking 150,000 a month in income that we can use.
The last loan I closed you was an attorney who had filed a loss in 2024, but we had 240,000 a month in income because he had $2.2 million in deposits.
So the buying power that these bank statements allow you to utilize is huge because you go from what on paper might look like somebody that doesn't qualify at all to somebody that now qualifies for a $5 million property, right? It's huge for a realtor, in my opinion, where you have that information up front when you're going out showing properties.
When you say bank statements, they can use the company bank statement.
Yes, sir.
And the individual own.
Yes, sir. If they own a business, they can use the business bank statements. By the way, you only need to own 25% of that business, and you can use those business bank statements. Or if you're a 1099, you can use personal bank statements. Now, that segues perfectly to what we have on this slide. There are derivatives, because what we're trying to do is give option solutions for self-employed borrowers. So if the bank statements don't work, and there could be a number of different reasons why they won't work, what happens? Well, if you're a 1099 borrower, we have the ability to use a 1099 only, right? So we're only looking at last year's 1099, and then we get an income statement from your employer. So like, say for one of you guys, we would look at your 1099 from 2024, and then we would say, hey, Tony, can you put together a year-to-date income statement broken down by month? So we can just make sure your income is in line with 2024, and now we don't have to look at the bank statements. Why would we do that? Well, maybe you deposit your money into 3 different accounts, so it doesn't show all good deposits in one account. Maybe for some reason you're not great at timing and you have a bunch of NSFs on your bank statements, right? There's a number of different reasons why we would pivot away from the bank statements, but we have more options. If you own a business, the equivalent of the 1099 program for a business owner is the profit and loss program, where we're only looking at a profit and loss. This has to come from an accountant, but they would give us a profit and loss for the most recent 12 months. And we're just going to use the net income at the bottom of that profit and loss. And then we ask for only 2 months of bank statements to make sure that the last 2 months deposits are in line with what that total revenue shows on the profit and loss. That's it, nothing else. Yes, sir.
So, you asked for 12 months or 20 months?
On the bank statements, we can do either or.
Within 12 months, is there a number of NSFs that are out?
Yep. Yeah, that's again, detailed question, but yes, there are. So if it's a 80% LTV or less, we can go up to 20. Over 80% LTV, it's only 10 minimum. So there's flexibility. Sure. The question was how many NSFs are allowed on a bank statement loan? And it is 80% LTV and below, we can go up to 20 of them. And then if it's over 80%, it's 10 of them. Mm-hmm.
You got to be really bad to be able to do 20 NSFs.
Right.
I don't think I've had 20 in my life.
So you guys can see how valuable, and I'm sure it's some, your wheels are turning a little bit here because I close probably 3 or 4 realtors a month. I do personal loans for realtors all the time because you guys are 1099, you don't show all your income on your tax returns. I can use your personal bank statements, or if you have a PA account, I can use your PA account, or if for some reason you mix the money between the two, I can just use your 1099, right? And we can get you into a property with your true buying power. So it's very impactful. These are some live scenarios that are kind of going to go through these slides. So this is a real life scenario. This is usually within the last 3 months. A self-employed borrower making 200 grand a year, has a credit score of 758. He wrote off 75% of his income. He's only left with 50 grand to qualify on a jumbo loan. He did not qualify. The bank statement program, we were able to approve the borrower for this program using the bank statement income. So that kind of goes to what we were speaking for earlier. All right. Yes, question. Great question. We can combine them both. So what we would do in that case is we would use the personal bank statements, unless they had a PA, we used a PA. But let's say it's personal. We use the personal bank statements. If both incomes are going into that personal bank account, we're going to pull out the W-2 deposits and use the remaining deposits. And then we're going to give you the full gross income of the W-2. We're going to ask for the W-2s and the pay stubs, no tax returns, just the W-2s and pay stubs. And you're getting the full gross of the W-2 plus the 1099 income.
So you mentioned how we use Uber and Lyft drivers, because that's another one that's very common nowadays. They work during the day, they drive at night or whatever.
Yep. So same exact thing. Usually Uber, Lyft are getting deposited into their personal bank account. And they're easy to see because the deposit comes from one of those companies. So we'll just total up all those deposits. We're using a minimal expense ratio on those. We hit them with a 15% expense ratio. So if you're 1099, by the way, we use 85% of the deposits going into your bank account, right? It's a lot of buying power. And then if they happen to be a W-2, to Joey's point, we can use W-2 income on top of that. And we see that a lot. Somebody has a standard W-2 job, but they do some Uber on the side. So we can combine both incomes. A lot of flexibility with this program.
And what about the credit?
Minimum credit score to qualify for the program is a 640. Yeah. But, and then that'll get you like a 75 loan to value. If you want to go higher and put less down, you need a little bit of a better credit score, of course. Yep. Any questions there? Good. Here's another scenario. Are you losing out on closing deals because the buyer had a recent credit event? Scenario: you have a family that has that was turned down by 2 other lenders due to a foreclosure that occurred 2 years ago. Our full doc program is the solution. The program will allow a grateful family to move into their dream home just in time to enjoy their staycation. So this speaks to credit events, bankruptcies, things of that nature. Unfortunately, sometimes bad things happen to good people, and there are some issues on credit, right? They might have had a BK, they might have had to take a modification, they might have had to do a foreclosure, maybe they fell a little bit behind on a mortgage. Conventionals guidelines are very strict when it comes to those. Non-QM was designed specifically to help those underserved buyers, right? So if you see that on one of your buyers, oh, I had a foreclosure a year ago, don't turn them away, give Joey a call. We do have programs that can accommodate somebody that had a foreclosure a year ago. We have programs that can accommodate somebody that had a BK less than just over 2 years ago, instead of having to wait what is it, 5 or 7 on conventional?
4 on conventional is 5.
Five, yeah.
Change, yeah. So
Chapter 13s, for example, we use the filing date for seasoning. So if the borrower came out of the Chapter 13 yesterday and they paid it on time, the filing date was always 3 years ago, we're good to go. We can do a loan for that buyer, right? So keep that in mind. Sometimes anybody that has a credit event, a BK, give Joey a call. We have options for those buyers. All right.
Leanette,
Leanette, oh, I'm sorry.
it's all
Sorry.
good.
Didn't know the structure.
It's all good.
Okay. All right. Here's another scenario. Oh, yes.
You should be right here in the front.
Yeah. I'm just kind of I wanted to ask, how much more expensive is it than conventional, let's say?
That's another good question.
I have a situation 2 years and went through a conventional lender, and they're saying you got to wait 2 years or coming up. But I want to know whether, is there a big difference?
It's a great question. So I'm going to give you an answer 2 parts. Specific to that scenario, somebody who just had a BK, it doesn't matter because they don't qualify conventional. So whatever the rate is, right? But now let's compare somebody that's straight self-employed, never had a BK, using their taxes conventional versus using their bank statements, going with a bank statement loan. You're talking about anywhere from 1/4 to a 1/2 point difference.
I was going to say, it's about
that. No, higher. Yeah, because these loans have a little more risk. We're not selling to the government. So they're going to be a little more. But that margin, that gap, and Joe, you can attest to this, has closed a lot. We're very close to conventional today. As a matter of fact, on investment properties, we're pricing better today than conventional does.
Yeah.
On investment properties, because they've kind of started to get away from investments. They've added LLPAs, et cetera. So it's a lot closer. But to your point, generally speaking, a non-QM loan is going to price anywhere from 1/4 to a 1/2 point higher than conventional. But keep in mind, these are buyers, like for self-employed buyers, you guys 1099, you guys know, would you rather pay an extra 1/4 on your loan, on your mortgage, or would you rather pay the taxes to Mr. Uncle Sam, right? So when you put it in perspective, most self-employed people understand that point, and they're more than willing to pay that little extra on a bank statement. 100%. Yeah, we have a 2-1 buy down that you see on the conventional side, and then we have your standard buy down where you could just buy the rate down if you choose to. Yeah, absolutely.
They're the biggest, Robert. They have it all.
Absolutely. All right. This next slide kind of goes into the next most popular program that we offer, which is for investor community specific. An investor looking to purchase their 19th investment property. Her prior funding was very costly because it was a hard money loan with high rates and fees. She was unable to qualify for a mortgage using tax returns. After a rental analysis was completed, she was able to qualify using our investor cash flow program, also known, by the way, as DSCR. I'm sure you guys have heard of DSCR loans. The investor was able to purchase her 19th home. So DSCR is the second most popular program in the non-QM space, and it's growing quickly, specifically for investors. And you don't have to be an experienced investor. You could be buying your first investment property. But the way this program works, to kind of give you an overview, is the loan does not require any income. You don't even have to have employment. You don't have no DTI. We're not looking at any of that. It's very simple. If you meet the qualifications from a credit standpoint, which is a 680 credit score, as long as the rent covers the mortgage payment, then we can do the loan with 20% down.
No, it's a future rent on that property.
Future rent on that property. Now, let's say the future rent does not cover the mortgage payment. The borrower puts 25% down, the rent can be 20% less than the mortgage payment. If that doesn't work, the borrower puts 30% down, doesn't matter what the rent is, they qualify. It's called a no ratio. PITIA, whole housing expense,
And association.
including the HOA. So condos can be, sometimes they have to put 25% down or maybe 30% down because we hit that high HOA. But, you know, single families, PUDs, rents are pretty high right now. We're usually, we can do 15% down. Mhm.
So mention them about the short-term rentals. That's another big thing coming up.
Short-term rentals are allowed under the DSCR program. So if there's a, you know, property that's specific or even a condo project that there's a lot of short-term rentals, we allow them 25% down. And the way we qualify these is pretty cool. We run a report up front, which is called an Air DNA report. Air DNA is a service that kind of pulls the comps of all of the short-term rental properties in the area of where that property is located. And it tells you what the estimated annual revenue would be for that property. We take that total revenue divided by 12. That's what we use for the rent.
So I just want to give you an example because I recently closed one with you. We did an Airbnb in Lake Placid. My client did 30% down because they had a big down payment. Interest rate was in the high sixes. This is on a no income loan for an investor. So when, to his point, a conventional loan right now with 30% down investment property is going to be like a high six rate right now too. Investment's always higher than primary. So it's a very comparable loan, except there's no paper.
Yep.
It's very minimal. Literally, it's like ID, assets, and pretty much insurance. And I think we're done.
They close fast.
And they close fast.
Guys,
So
this one is a huge asset for you guys. And I'm going to go into a few more details. So a few other cool, neat things about this program. Back to the ratio we were talking about. To your point, we're using the PITIA. If for some reason we're having a hard time meeting that ratio with the rent, you know what we can do? We can use interest only. We have an interest only feature where we use the interest only payment to meet that ratio. So now the interest only payment just brought the mortgage payment down. The rent now covers, right? So we have that option.
You can do 15%.
You could do, with interest only, you need 20% down if you're going to use the interest only option. The point is there's numerous tools to make these loans qualify. You can close in the name of an LLC, not allowed in conventional. In the non-QM space, it's actually common. That's really most of the DSCR loans I close fund in an LLC or a corporation.
When you're doing that, you said another LLC.
Yes, if it's multi-members, we prefer max of 2, but we will make exceptions if there's more. We just need them all to be on the loan. So we do need them all to qualify. We pull all their credits. Yeah. Another feature, this is brand new, Joe. We actually rolled it out today. You'll see an announcement on social media today. So if the loan is a 75 LTV or below, if your borrower is putting down 25% or less, when the loan is pre-approved up front, when I review the credit report and the application to issue a pre-approval, we run an AVM for the rent comp at no cost to the borrower. We run it. That rent comp is what we use to qualify. You no longer need to order a 1007.
nice.
And so now we no longer a question mark of when the appraisal comes in, what's the 1007 going to say? We know up front.
So just for you guys, the 1007 is the rent schedule from
rent
the
schedule.
appraiser. And you guys know how appraisers are. That's an opinion.
It's an opinion.
It's an opinion. So you might get the good opinion, you might get the bad opinion. So now we're going off of an AVM. There's an appraisal.
There's an
for the
appraisal.
property.
You no longer need a rent schedule. So we eliminate that from an appraiser's opinion. And it also saves your borrower $250. Yeah.
But you say you do it before we are in a condo, but you need to have the property already.
We need to have a property address so we can run the
Or a
AVM.
project.
Right. Or if it's a condo or project, right. Exactly. Yep. Yep. So a lot of great features for investors on this. Again, you don't need to be an experienced investor. You could be buying your first investment property and no income, no employment, just looking at the rent that the property generates, and you could be purchasing your first investment property. Pretty cool. Okay. Gifts are allowed on this program. Buyer needs to bring 10% of their own money and have 3 months reserves. The rest can be a gift. And 6% seller concessions are allowed on this program. Yeah. Yeah. I mean, again, this is
Talk
why
about a way
I
to make
love
a deal.
sharing this information with you guys, because it's important. There's a lot of great features here. All right. Move on to the next one. This one's a quick one that you guys are probably familiar with. Are you losing out on closing deals because sellers aren't accepting your buyer's offers? Buyer placed an offer on a property, only have the seller select another offer. The buyer had plenty of cash to buy the property, but they didn't want to keep it tied up in the property. Delayed financing was the solution in this case. So we do offer delayed financing. We offer it across the board on all of our programs, bank statements, full doc, DSCR. So if you have any buyers that are buying properties cash and they want to be able to pull that cash right back out, we can do that for them. We see that a lot on 1031 exchange buyers, investors that are using 1031 exchange. So you have that ability to do that as well. Are you losing out on closing deals because buyers are watching their cash flow more closely? This speaks to interest only. With the increase in property values and rates, monthly mortgage payments are on the rise. Borrowers may not want to tie up as much of their monthly budget in their mortgage payment. The solution is interest only. So I'm going to talk about how this interest only works. Our interest-only program, and again, this is unique to non-QM. There are no interest-only programs on the conventional side that I'm aware of, is you could use interest-only on a bank statement loan, on a DSCR loan, on a full doc loan, on a non-warrantable condo. We can use interest-only on all of those programs. So it brings down that monthly payment, okay? I know you guys know how interest-only works, but yes, question? Yeah. Delayed finance? No, it's more designed where your buyer has cash. So they're buying the property in cash, right? Because they just want to, you know.
And then we reimburse them afterwards.
And
with
we
a
reimburse them
mortgage.
after.
So like you want to get advantage of making a negotiation in cash.
Right.
Because you want to take advantage of getting a really good deal on the house.
Yeah.
You got the money, they want to close in a week or 2 weeks, the mortgage is going to take too long. Later on, we can go ahead and we can get the mortgage in place for them so they can close a month later.
Right. Mm-hmm. So the interest-only feature, the way this works is there's two different versions, but basically the first 10 years of the program is a monthly recast option. I don't want to get too detailed in the weeds, but I think it's important that you guys know, because the borrower's minimum payment every month is going to be only interest. They're not paying principal. However, if they choose to pay principal, so let's say this month their balance is $100,000 and they decide I'm going to pay $10,000 down on my principal. Next month, the new balance is $90,000. Their interest-only payment that next month is based on $90,000.
It's like a credit card.
But you will have a cap.
Not 100. No cap.
No, well,
They can do this until it's paid off.
No, but cap on the amount you pay.
no.
Only if it's an investment property. If it's an investment property, there's a prepayment penalty. But if it's a second home or a primary, there's no cap. There's no prepay. They can knock it all the way down.
So it works like a credit card essentially.
I have done loans for self-employed borrowers. They love interest only because self-employed borrowers sometimes don't know. They might have a good month, a bad month. Their business is fluctuating, right? So I've done interest only loans where they've gone into it and they took it out interest only first 10 years and have literally been able to pay off the property in 5 years while having a minimum monthly obligation. Because every time they had a big month, they put a bunch down on the principal. The next month, their monthly payment went down. Then they did it again. And they kept knocking it down. And in 5 years, the property was paid off. So really cool feature there. All right. Purchase, rate and term, cash out, refi. Absolutely.
You need a loan? I got you.
Rate and term is a refi where we're just paying off the first mortgage and putting them in a better new mortgage. Okay. The only other thing that wasn't on here that I do want to mention to you guys that we offer is we offer home equity lines of credit or closed-end second mortgages. And we qualify those using bank statements. So they don't have to have full doc on those. Or we have a DSCR option to qualify that. Why is that important to a realtor? Because if you have any investors that you work with or any past clients that maybe are interested in buying another property, they might be able to tap into the equity in their current property, pull out the cash through a HELOC or a second mortgage and use that cash to purchase another property. We're seeing that a lot now. As a matter of fact, we do the simultaneous closing. We're actually closing both at the same time. They close the HELOC, we move the money right over to the title company, close on the purchase, same day. Okay, so something to keep in mind there as well. All right, so that's kind of an overview. Self-employed borrowers, jumbo borrowers, credit issues. That's a good point, jumbos. So just an FYI, on non-QM programs, there is no conventional jumbo. All of our programs go up over 4 million, over 3 million in loan amount. So some go to 4 million, some go to 3 million. So there's no, you don't have to worry about jumbo or anything like that. Anytime your loan to value is over 80%, there's no mortgage insurance. There's no PMI with non-QM loans because it's not a government loan.
Over 20% down.
Less than 20% down. In the conventional world, you have private mortgage insurance. There is no private mortgage insurance on the non-QM side. Okay. Yes, sir, Tony.
Do you have any programs for fix and flip investors?
I don't, but Joey has access to some with other lenders. Leanette, I should say,
We
has
have- yeah,
access
we-
to some with other
We
lenders.
have a couple fix and flip. We do.
Yeah, there's some lenders out there that specialize in rehab, fix and flip, et cetera. We just don't offer that product.
I want you, before you're going to talk about your condo specialties, right?
Yeah, I'm going to go into
Yeah.
condo for sure.
That's really our market too.
These slides are pretty cool, guys. I'm a data nerd, so I love this stuff. But just to kind of give you guys an idea of the market you're looking at, and I always like to preface this slide as you could probably take these numbers and I don't know, bring them up 30% just for the state of Florida for the market that we're in. But 36% of U.S. workers are a gig worker in some capacity, meaning they have some sort of self-employed side job type of thing going on. 59 million people categorized in the gig economy. 17 million people are categorized as self-employed. The state of Florida has led the nation 5 years straight for new business formations. To give you an idea, I mean, I'm sure you guys, everybody we know out here has got some sort of a side
Until
hustle,
next
right?
week, after Mondami wins.
Exactly. There'll be more coming down. So, this kind of just shows you the increase in the size of the market that's out there for you. Investors, 36% of homes today are rental properties. There's a year-over-year change kind of by graph. 10 to 11 million is the number of individual investor landlords. These are not institutions, individual investor landlords managing an average of 2 units or more. This is another huge market here in South Florida. We see a lot of people that are real estate investors, accumulating properties, building assets. All right, so before we talk about this one, I'm going to go into Joey's point. So the other program that we are very well known for, specifically Angel Oak, and I've kind of become a master in, is non-warrantable condos. And that's specific to our market here in the state. Thankfully, the condo market here is on the improvement. I think we're on the downside of all the issues that we went through after Surfside. But for many years, we had a lot of issues with buildings having to go through the 40-year inspection, 10-year, 15, 20-year, et cetera. Their reserves got tapped out. They started, going out and taking higher deductibles on the insurance to try to save money, a number of different things that made the projects non-warrantable condos. We specialize in them. We have our own program for them. We do them specifically. There's a number of reasons why a condo project could be considered non-warrantable. I just mentioned a few of them, litigations, et cetera. We pretty much have a solution for the majority of them. The most common ones that we're still seeing today is the insurance. As I mentioned, they go to 10% deductible to try to save money. You need a 5% deductible for conventional. We allow a 10% deductible on hazard. Windstorm insurance, we allow up to a 15% deductible. We don't have any set standards for minimum coverages, whereas conventional is very defined on the minimum coverages you have to have for each different coverage.
Do you guys remember we talked about the insurance coverage, the checklist?
Yeah.
All those checklist items don't really apply like this.
Correct.
So when we have those issues, we go this route.
Inspections, not something we require. It's not a decision-making factor when we decide if we can lend in a project. Our condo questionnaire, our non-warrantable condo questionnaire, does not even ask if they've had a 10-year, 15, 4, whatever. We don't care about the inspections. We don't ask if there's any ongoing construction in the project. We're not concerned with that. Those are not issues that affect our decision-making in the building.
So like on the Fannie Mae one, like we talked about, where they asked about, are any projects happening right now? Are there any critical repairs? It's not a thing.
Correct.
So
Correct.
somebody asked me about refreshing balconies, concrete restoration, I think got that question here. That wouldn't apply.
Correct. Rec leases, we do. Yep. The key is just to make sure that there's more than 30 years remaining on the lease. And as long as there is, we're usually okay with it. We just review them on a case-by-case basis. Land leases, we do those as well. Century Village, right, in Pembroke Pines, we do those all the time. Yep, just to kind of give you an idea of some of the ones we do. Reserves, conventional is very straightforward. You have to use the reserves that are being collected on the current year's budget. In our world, that's only one part of it. We also ask them on our questionnaire, what's the balance in the reserve account today? We know you're collecting X, but there's usually some money sitting in that reserve account. We add the two together, and that's how we calculate our reserves. So we save a lot of loans that way as well.
But that will change because now the law requires.
No, there's so the law's been requiring, and there's still buildings that we see that don't have 10%.
Yeah.
All the time.
It's a guideline that they have to.
Yeah. Well,
Yeah. But unfortunately, some of these buildings are still catching up with the inspections, and they're still spending that money to try to, get all this work completed, so they don't have the reserve. Yeah.
we see it a lot.
It's getting better. It's getting better to your point, but yeah. So the point is, again, more options. So if you guys go into a building that your buyer's interested in, come across a building that maybe others have had a hard time selling a property in, you can feel comfortable saying, no, we can probably get this loan done. You can sell the property in that building. Okay. So this slide here kind of just gives you some ideas on where you can find these borrowers, put this information out on social media, go back to any turn downs you might have had in the past. If you guys can think of anybody you might have turned down for one of these reasons, talk to builders and developers. Guys, builders and developers don't offer these products and programs. So you could be of value there to sell some properties in a new construction project or whatever the case may be, because you have access to them. Accountants and CPAs are a great way to tap into a self-employed community. Financial planners, same thing there.
You have any friends that work at a bank?
Yeah, friends that work
I
at a
have a friend that
bank.
works at PNC who sends me all the turn downs.
Yeah, all of those banks, Bank of America, Chase, PNC, they don't do non-QM. They they do not
There's
offer.
no exceptions.
There's no exceptions. They don't offer that product, right? So those are great ways.
They
to
barely get the conventional stuff done.
Yep. And anybody in your sphere of influence. I mean, the old joke in South Florida is you can walk outside and trip over somebody that's self-employed in some way, shape, or form. You can trip over somebody that's an investor buying investment properties, right? What not to do. Don't tell your self-employed buyer not to not claim deductions for 2 years so they can qualify for a conventional loan. That's a common one, right? Like, oh no, you have to wait 2 years. You have to stop claiming losses and wait to build up your income. No. We can buy today. Let's take a look at your bank statements. They're going to miss out 2 years of appreciation tax benefit. That kind of just goes into a little bit more detail on that. Instead, call Leanette first.
Leanette.
I'm sorry. That's wrong. All right. Joey said
Sorry, Scott.
Yeah. Don't tell your investors they own too many properties. With the DSCR program, total number of properties don't matter. Instead,
That DSCR thing also makes it really easy. Sometimes people inherit money. They already own a property. They want to, oh, should I take money out of my house? Or, you can take money out of your primary residence and come up with a down payment and become an investor.
Yep.
Like easily.
Yep.
And it doesn't have to be, it's not that difficult. Like people think it's hard to qualify, but it's really not. The DSCR loan makes it very possible for people to become investors. We have done numerous people have 5, 6, 7, 8 properties. And that's how they build these portfolios.
Yeah, that's why I mentioned the HELOCs and the closed-end seconds, because that's not something that a realtor would sell, right? But if you have somebody that you sold a primary residence to and they have a 2% rate because they bought it in 2022 and they don't want to touch that rate, but they have all this equity and they want to invest. Now, here's a way you can get it done. Pull out that equity, home equity line of credit, closed-end second mortgage, whichever one they prefer.
And you don't have to be perfect to get the home equity line with them. Like
Exactly.
at a bank, the home equity lines, you got to be perfect. We have the option for the little dings and dents for the self-employed or whatever the case is.
Yep. So that's pretty much it, guys. Again, the idea here is to provide options and tools for you guys as agents to be able to put buyers into homes and have the knowledge that all of these products and programs exist. Hopefully some light bulbs went off and some wheels are turning.
Got some questions.
Yes, sir. Foreign national? Okay, we didn't mention that. Great point. So foreign nationals, we do. We do them as DSCR loans. So this is pretty cool. The only thing we need for a foreign national is a copy of the visa if it's a country that requires visas. There's many countries that don't. And then if it's a purchase, the funds to close, the assets. We want to see where they're coming from. So we go back 60 days on the assets and we ask them to bring the funds to close into the US 30 days before the closing date. But that's it. Other than that, as long as that rent covers the mortgage payment, then the loan qualifies. That's a great question. We do investment properties for 60 days on the asset seasoning, 30 days of which it has to be in a US account. Yeah.
Countries that we can't do.
Countries we can't do is whatever's on the US OFAC list. And that's the government updates that frequently. It's usually just your communist countries that are, we can't lend it.
Soon it'll be New York.
But that's very, but it's a very good question. And if you think about it, no credits reference letters from their country, no credit report required, no income from their country, no CPA letters, none of that stuff. It's literally just visa, assets, DSCR ratio, done. Unfortunately, yeah. Unfortunately, they're not. They're on the OFAC list. Yeah, currently. Yeah. Although that could change.
We don't know when, but
Yep.
hopefully soon.
Yep. Any other questions?
Do you do loans outside of the state?
We do. Yes, we're licensed across the whole country.
And Leanette can participate in DSCR all over the.
Correct.
Wherever we're licensed.
She can participate in DSCR loans outside of the state of Florida. So if you have buyers that want to buy, an investment in North Carolina, whatever, Georgia, the mountains, whatever, we can do those. Yep.
All those people that want to buy those beautiful cabins in Tennessee.
That's right.
All right, good.
Cool.
Is there any questions on the chat? Tony, was there any questions on the chat? Were there any?
Yep.
So we can get him delayed financing. Let's go.
Yeah, it was his cash he used to buy the property.
We're on the stock market, so he liquidated buying cash because his credit is around 630, something like that. And his income he can show is, I think he shows like 30,000. But he basically had the asset.
Perfect scenario.
So that's
Was that an investment property?
no.
Is it primary? Okay.
Self-employed? Yeah. Bank statement.
Yep. Thanks, Emily.
Well, tell him we can cash him back so he can buy another one. We'll put the cash back in his pocket. He can buy another investment property.
All right,
right,
guys.
awesome.
Thank you for your time. Appreciate you guys. Yes. Yes. Correct. We're a wholesale lender only. We don't work with borrowers directly. My clients, our clients are mortgage brokers, loan originators. So